macro market trends, stock selection, ETFs, options. Just some of the topics covered in Cook's Kitchen.
Are equity markets waiting for Godot? One good compromise out of Washington and we lift higher? I think not. I think they'll be disappointed, and I am now in sell the rallies mode, and I'll talk a little bit about why. Still a bull longer term, but we need to have some caution here. Let's take a look at the S&P chart first. All right, here's where we are. Broke down through 1680. That's my red line. And the 50-day moving average is right there. So a lot of talk about, hey, we're above the 50-day moving average, we're below the 50-day moving average. Yeah, it's a good trend marker, but it's not a line in the sand as much as people make it out to be. What's more interesting about the 1680 level is when it was prior, resistance, support, and then it was support here for about a week. And we just cracked through it. 1650 was an obvious next target. This green line is roughly 1630, 1635. That was an important level for me back here in June. So once we got up through it, I was a bull in July. It proved to be very key support in late August, early September. It looks like it will probably get tested at some point here, and you've got the 200-day down at 1599. All right, next I want to take a look at the NASDAQ. NASDAQ 100. And I'm going to profile a trade here that we had on. First of all, just look at the levels here. NASDAQ 100 was pushing into brand new highs above 3250. Last week, we talked about the NASDAQ strength and the Russell 2000 strength as leading the market. And I asked, this is good breadth, but there's also some froth in some of these stocks in the NASDAQ and elsewhere. And there's this theory among some technicians that sometimes too much breadth is a bad thing. When you have, when you've got stocks across all indexes and sectors making new highs, that sometimes precedes a top. And so that was the question I asked last week. That still isn't confirmed. But you saw this. You saw the NASDAQ still holding up the rest of last week, and then early this week before the cave yesterday on Tuesday. Let me show you what I did wrong. Okay, so we were long NASDAQ, triple leveraged ETF, caught a good bounce here, and we're making some money. And as it held up, I felt pretty good and was eyeing 3,300 as a level. A target that I wanted to see it take out. Well, turns out I got cautious on Friday when Boehner basically dug in his heels and he was insulted by the Democrats. And we got more of that talk on Sunday. So on Sunday, I told Market Timer subscribers to be cautious, and I had opportunities to sell. I had an opportunity to sell on Monday, and I had an opportunity to sell on Tuesday, and I missed it by minutes before this thing cascaded. Point in fact, at just before 10:30 Eastern on Tuesday, I'm typing up a sell alert. Hey, let's take our profits here. Let's just cut this for now. And a half hour later, the NASDAQ cascades about 1%. I think we're going to see some more downside follow through there over the coming weeks as we approach the debt ceiling deadline, because it doesn't look like things are going to get smoothly. And I see this Washington scenario just as a catalyst for something that's been building. Could be a longer topping process that's been brewing over the summer here, and it could be time for a bigger correction. All right, so when I gave up these profits here in the NASDAQ, turned a nice profit into a bigger loser. That really stung. I told subscribers I sort of felt like Tony Romo throwing another interception to lose the game. Now, nothing bad against Tony Romo, and I'm not comparing myself to him. I think he's a great quarterback. Comes from my neck of the woods up in Burlington, Wisconsin, and had a fantastic game against the Broncos on Sunday. But everybody, of course, piles on him for throwing another interception to lose another game in the fourth quarter. Let me show you how I can sort of relate to his feelings. So here I was on Friday and Sunday writing to Market Timer subscribers about Boehner, being insulted on Friday and then how he dug his heels in again on Sunday talk shows. I said he's pissed off and he's dug in his heels. This is not good for equity markets. I think it is a confirmation of a potential extended standoff in Washington. I'm not saying we need to sell positions on Monday morning, but the price action will tell us a lot about how serious things are becoming. Consider us on red alert for a scenario where the S&P could take out the 100-day moving average and S&P 1650. That's only 2% lower from Friday's close at 1690. If that happens, we'll know October could be a very red month because the last 2 weeks have simply been postponing the inevitable. So, that's where I was. My mindset and game plan coming into Monday, even though I had a map that made me a buyer in the 1660s, conditions were starting to change. And you saw price action telling you, price action sort of holding up in a false confidence way, like, the shorts are on edge and bulls are waiting to buy because a deal is going to get announced anytime. Of course, that didn't pan out, and that's why we had the big sell-off on Tuesday. We're probably going to bounce and chop around more today. Obviously a deal could be announced anytime. Even if we hear both sides come out and say there's going to be some kind of resolution here, on the continuing resolution, and a debt ceiling agreement or compromise without talking about Obamacare, I think you're going to get a temporary pop in the market, and that will be sold because of that 1680 line. We sat there. I don't think we're going to go back up through it anytime soon. All right, so, for me, this is a lesson in sticking to your game plan, but also following your gut when you sense that conditions are changing. It's a lesson that all traders have to learn, and sometimes you get to relearn it over and over again until you get it right. I'm reminded, after the Broncos game, Cowboys game, fantastic game by both quarterbacks, Manning and Romo. I heard that Jerry Jones said that, it was a moral victory. There's Jerry. He's a winner, obviously, and he can call it a moral victory if he wants. I know one guy who might disagree, though. Let's go back to 2002. Herm Edwards. Remember what Herm said when asked about their season? He said, "You play to win the game," and that's really what it's about. Is we can learn new things, have moral victories, but we play to win the game. This week I felt like I lost a little bit. We're entering a new game, and I think there are going to be opportunities to buy dips and have some volatile bounces on news. But I think that when I look at my three major windows on the market, I'm seeing a sell the rallies mode. Three major windows, fundamentals. In just the third quarter, on June 30th, earnings growth estimates for the third quarter were at about 6%. In just that time, that got cut in half. I think they were at 6.5%. It got brought down to 3% growth for the third quarter. So the fundamentals aren't there. Technicals were breaking down or we're just in a longer topping process. And I think institutions will be in sell the rallies mode. And that's the third leg of the stool, is what is the expected behavior of institutions. You've got guys like Julian Robertson coming out and saying, I don't see anything here I like. And he's not the first large veteran investor to come out and say that. So I think things are coming together here for a sell the rallies mode. And even on some of the best news, I have a hard time seeing the market making new highs above 1,700 before we go down and test 1,600. So we're right in the middle at 1,650, and that's the way I'm leaning now that we've taken out some decent support around 1,660. All right, I think I've covered it all. Just let's keep Herm Edwards in mind. I always say mind the risk, bank the profits, and Herm would phrase that as play to win the game. All right, thanks for joining me.